So, you're thinking about closing your limited company. That's a huge step. Whether it's the end of a fantastic journey or just time for a change, it can feel pretty complex, maybe even a little overwhelming. But you're definitely not alone in this, and having a clear map is the key.
That's exactly why we're walking through this guide from the experts at ProTax Accountant. We're going to break it all down, step by step, to help you understand the rules and make the absolute best choice for your company, your finances, and your future. All right, here's what we're going to cover. First, we'll talk about knowing when it's time. Then, the most important question of all, solvency. From there, we'll look at the paths for both solvent and insolvent companies, touch on your duties as a director and the dangers, and finally, wrap up with why getting professional help is so important.
Okay, let's start at the beginning. You've reached a point where closing the company is on the table. It's a massive decision, and that's why having a clear plan is non-negotiable.
And there are tons of perfectly good reasons for this. Maybe the owners are finally ready to retire. Or hey, maybe the company just did what it set out to do. Sometimes a business just isn't profitable anymore, or you're itching to start something new. Whatever your reason, the process needs to be handled the right way.
Now we get to the single most important question in this entire process. Seriously, think of it like a fork in the road, because your answer will send you down one of two very different paths. Is your company solvent? And really, it all boils down to this. Can your company pay all of its bills and debts as they come due? You've got to be brutally honest here, because the answer literally determines, by law, which path you must take next.
So let's break that down. If you're solvent, you've got more assets than debts, you can pay everything off, and most importantly, you have choices. But if you're insolvent, the game changes completely. Suddenly, your legal duty flips from your shareholders to your creditors. It's not a choice anymore, it's a legal requirement. Okay, so let's take the first path. Let's say your company is solvent. Good news! This means you're in the driver's seat and you've got a couple of really solid options for closing things down cleanly. You've basically got two main choices: a company strike-off or what's known as a members voluntary liquidation, MVL for short. A strike-off is the simpler, quicker, and cheaper route. It's great for companies without a lot of assets. The MVL is more formal, but it can be way more tax efficient if you have a decent amount of cash to distribute. So, if that strike-off sounds like the right fit, here's how it generally works. You have to stop trading for 3 months, pay off absolutely everything, and then file a DSO-1 form. And this next part's crucial. You have to tell everyone involved, shareholders, creditors, you name it, within 7 days. Then, you wait.
Right, so why would anyone choose the more complex MVL? Well, it often comes down to this magic number, £25,000. If your company has more than that in assets to pay out, an MVL can allow that money to be treated as a capital gain, not income. That one little change can save you a significant amount in tax. And just a heads up, that strike-off process isn't instant. Once you file the notice, a 2-month clock starts ticking. During that time, anyone you might still owe money to, like HMRC for example, can see the notice and object, which would halt the whole process right in its tracks. Okay, but what happens if you're on the other side of that fork in the road? What if your company is insolvent? This is where things get really serious. Your choices are pretty much gone, and now you have a legal duty to act in a very specific way to protect the people you owe money to. The path you almost always have to take here is called a creditor's voluntary liquidation, or a CVL. As a director, you have to initiate this. An insolvency practitioner is brought in, and their job is to sell off the company's assets and make sure creditors get paid back fairly and legally. It's no longer about you, it's about them. Now, this is absolutely crucial. Whichever path you're on, solvent or insolvent, your responsibilities as a director do not just vanish into thin air. And trust me, the consequences of getting this wrong are severe. Just look at this line from the Companies Act. It basically says that just because the company is gone doesn't mean your personal liability is. If you've cut corners or acted improperly, they can still come after you personally, even after the company has been dissolved. And when we say serious, we mean it. You could be on the hook personally for the company's debts. You could be banned from being a director again for up to 15 years. We're talking massive fines, investigations, and in the absolute worst-case scenarios of fraud, even prison time. So, after hearing all of that, it probably leads to one very obvious conclusion, right? Trying to navigate this minefield on your own with so much at stake, well, it's just not worth the risk.
Because choosing the right way to close your company isn't just a bit of paperwork. It's a critical decision that's going to affect your personal finances and your legal reputation for years to come. Getting it right is everything.
Look, if any of this sounds like the situation you're in, please don't try to figure it all out by yourself. The team at ProTalks Accountants specializes in this. You can reach out to them for clear, expert advice on WhatsApp or by phone at 07-985-689912, or just drop them an email. And hey, for more straightforward advice like this, make sure you subscribe to the YouTube channel. Thanks for joining us.